Hello, everyone. Welcome to the Debt Circle and the Fixed Income powered by Tipson's webinar, the second webinar, which is the topic is Decoding Corporate Bonds and Understanding Risks and Rewards Related by It. And it's exclusive by Ms. Mansi Kariya. And I'm delighted to introduce Ms. Mansi Kariya, who's Associate Vice President and Fund Manager, Debt at PPFAS Mutual Fund. She joined PPFAS in 2018 as a debt dealer, steadily growing into the role of credit research analyst within the fixed income team, and eventually into her current role as the co-fund manager for debt. Before joining PPFAS, Mansi worked as a research associate and senior executive in debt products for over 3 years, gaining extensive exposure to credit and fixed income markets. She's academically accomplished with a BCom, that's honors, from Calcutta University, a master's in finance from ICFAI University, and she's also a CFA charter holder. We are privileged to have her here today. Hello, ma'am. Thank you so much for joining us, and I will give you the screen. Thank you.
Thank you very much for inviting me in this webinar. Today we discuss about corporate bonds and how the things has evolved in the same. Corporate bonds are debt securities issued by companies to raise capital for various business purposes, such as expanding operations, refinancing debt, or funding new projects. When investors purchase the bonds, they effectively lend money to the company. In return, the company agrees to pay periodic interest payments known as coupons, which may be fixed or floating, depending on the bond terms. At the end of the bond term or maturity, the company repays the principal amount to the investor. By subscribing to a corporate bond issue, investors assume the role of creditors rather than owners, meaning they don't receive any equity in the company, but they are prioritized over shareholders in the event of bankruptcy. Let us learn about the few concepts regarding corporate bond investments. Coupon. Coupon means the periodic interest paid by the issuer. It may be fixed, may be floating on some benchmark. It may be paid annually, semi-annually, quarterly, as agreed in the information memorandum, which is issued by the company at the time of issuing bonds. It gives stable income to the investors in the form of interest. Capital gains and losses. Capital gains and losses matter if the person wants to sell the bond before maturity. It is based on the market price of the bond at the time when you sell the bond. Because as you all know, when interest rate rise, bond prices fall, and when interest rate reduces, bond prices rises. If the person held the bond till maturity, what they earn is periodical coupon plus the principal money invested at the time of maturity. Yield to maturity or Y2M is another important aspect in bond investment. It is the expected annualized return one can expect while investing in bonds. It assumes that you are holding the bond till maturity and your coupons are invested at the time of Y2M. Bonds price trade in market on the basis of yields, that is Y2M. It changes on the basis of changes in interest rates. Now let's talk about holding period return. This is the actual return an investor earns while holding a bond, including any income from coupons and any capital gains or losses from selling the bond before maturity. So in short, even though bond itself pays 7% a year, person can gain more or less from capital gains and losses, and they can cumulatively calculate holding period return. Another important aspect, but it is rather complicated, is duration. Duration calculates the sensitivity of the bond to changes in interest rates. It is the minimum time that is required to invest in a debt security to minimize the interest rate risk. Longer tenure bonds corresponding high duration and are highly volatile with respect to changes in interest rates. Now about how corporate bond market in India has grown. In the debt market, corporate bond market net outstanding rose to rupees 53.6 lakh crore as at end March 2025, growing at a 5-year CAGR of 10%. Corporate bond recorded the highest ever fresh issuances of rupees 9.9 lakh crore during 24-25. The surge was driven by tight liquidity conditions and the issuance was very well absorbed by the market as investors looked to lock in high interest rate, aligning strong supply with strong demand. While the bond market in India has growing steadily, bond markets, corporate bond markets still make up only 23% of the total bond issuances. One of the key reasons for this relatively low share is limited awareness among investors, which lead to lower participation in the segment. But the investor awareness is not the only factor. There are several other structural and regulatory reasons behind this trend, and that's exactly what we'll be discussing today. Corporate bond offers long-term cost-efficient funding for issuers and provide duration-matched assets for institutions like insurance and pension funds. A vibrant bond market helps spread credit risk beyond the banking sector, acting as a spare tire during financial stress. Now, few more jargons regarding corporate bond market. Primary bond market is where the bonds are issued, essentially the birthplace of bond. Hence, entities like corporation, governments, and corporates raise capital by selling bonds directly to investors. It is similar like an IPO, but for bonds. Once issued, bonds are traded in the secondary market where they are bought and sold. Liquidity in the market may vary depending on the type of bond issuer. A key indicator of liquidity is bid-ask spread. The narrower the spread, the more the liquidity. Now, secured and unsecured bonds. Secured bonds are backed by a specific collateral, such as physical assets or revenue streams, giving investor a legal claim on those assets if the issuer defaults. This added security makes them less risky, but they typically offer lower returns. In contrast, unsecured bonds are not backed by any collateral. They rely solely on the issuer's creditworthiness. As a result, they carry higher risk and the corresponding higher rates. Listed bonds. Listed bonds are traded on the exchanges like NSE and BSE. Because they are available on public platforms, they are easier to buy and sell, offering greater liquidity and transparency. Unlisted bonds are not traded on any exchange. They are typically sold through OTC transactions or specified bond investment platforms. While they may offer higher returns or unique structures, they often come with lower liquidity and less regulatory oversight. Now, about private placement and public placement. When a company opts for private placement of bonds, it offers its bond to a select group of investors or institutions, rather than making them available to the general public through an open market. This approach allows companies to raise capital more quickly and with fewer regulatory requirements. In contrast, public offerings such as initial public offering or public placement of bonds involves offering securities to the broader public. These offerings must comply with stricter regulations, including mandatory disclosures and approval by SEBI. Public issuances accounted for just 2%, whereas 5.88 crore via private placement. The main reason for the lower public placement is the issuers greater want greater surety about their placement because the institutions give them competitive bids. Now about listed bonds. In financial year 14, unlisted securities account for 31% of the total secondary market corporate bond volume. By financial year 24, this share has considerably declined to just 10%. This trend indicates a clear preference among investors for listed corporate bonds, driven likely by the greater transparency, regulatory oversight, and liquidity that listed bonds provide. The declining volume of unlisted securities in this secondary market underscores the growing importance of listed bonds in India's corporate bond market, reflecting a move towards more standardized and secure investment options. Secondary market volume, though improved, as you can see in the slide in my right, the volume improved has at to 7125 crore for the daily average market volume, but remain lackluster with no major improvement in daily or monthly turnover. Average monthly turnover at 3.8% of the outstanding value. The volumes didn't increase with the increase in outstanding bonds. Now, how bonds yield? Bonds yield based on the credit rating. They need to take the credit rating from the approved rating agencies such as CRISIL, ICRA, CARE. These are the credit rating is an independent assessment of a corporation or a government's ability to repay a debt, either in general terms or regarding a specific financial obligation. All the public issues corporate bonds need to be rated by rating agencies such as CRISIL, ICRA, CARE, etc. Bond ratings are a key tool for investors to evaluate the credit risk of a bond. Higher rated bonds typically carry a lower risk of default, while bonds with lower rating present higher risk. Investors can use these ratings to match their investment with their risk tolerance and financial goals. However, it is crucial to keep in mind that while bond ratings are a significant factor, they should not be the sole criterion for investment decisions. The ratings here are all the investment grade ratings. Now, who issues corporate bonds? Corporate bonds are issued by PSU and PFIs, corporates, banks, and NBFCs, HFCs, and there is a new class of issuers, the infrastructure finance companies, REITs, and InvITs. Corporate bonds issued by PFI and PSUs where majority or 100% shareholding is owned by the government. This company get a competitive rates as regard with maturity ownership and hold a large amount of outstanding issues. These issues are widely accepted by pension funds, insurance companies, etc. Banks, NBFCs, HFCs also hold a large share in outstanding issues. Corporate also to raise money, but the share remains low to 10 to 15%. There is also an inclusion of REITs, InvITs, and municipal issuers in the market, which is expanding the market, and investors are very well accepting the bonds of REITs and InvITs. How corporate bonds are priced? Corporate bonds are priced generally above the GSEC curve. The spreads include credit quality, liquidity, and there are many other demand supply factors. Different structure of bonds trade at different spreads, such as strips, embedded option bonds, broker IPs, and there are many. The development and resilience of India's corporate bond market are supported by several factors, most notably a well-developed government securities market which acts as a benchmark. Corporate bonds are typically priced off the sovereign yield curve, and a stable credit spreads indicate market maturity. Data over the past decade shows that 5-year AAA rated corporate bonds closely tracked 5-year government securities, confirming the government yield curve a reliable pricing backbone. Moreover, credit spreads have behaved predictably, widening during periods of domestic or global stress, highlighting the market's growing depth and ability to price risk effectively. You can see the two different yield curves from 2021 and 2025. Both are ends, one is of end September and another is of end August. As you can see in 2021, AAA PSU bonds yield even less than SDLs because of the huge demand by institutions at that time. At that time, there's no premium to take the credit risk, but as of now, July 2025, the yield curve, you can see that government securities, AAA PSU bonds yield more than SDLs, and it is a right time to take credit risk at this time. However, there is a different spreads for AAA. The PSU bonds are the benchmark for the AAA bonds. Then you have NBFC AAA, HFCs, and then you have corporates. Every segment of the yield curve depends on the demand supply factors, and each maturity act on the basis of segmental demand and supply. As of now, last week, because of that higher SDL issuances and the various concerns regarding tariffs, the curve has really moved in within a month, and now the more than 3-year PSU bonds yield even less than SDLs. Risk in corporate bond investment. Corporate bond investment provide stable income and diversification that are the most important. But you should also be aware of the risk in corporate bond investment. Interest rate risk. Interest rate risk becomes important if you plan to sell a bond before it matures. As you know, bond prices move inversely to interest rates. When interest rate rise, bond prices fall and vice versa. This means that if you sell your bond before maturity when market interest rates are higher than the bond's Y2M, you may incur a capital loss. To manage this risk, the best strategy is to match the bond's maturity with your investment horizon or financial goal. Holding the bond until maturity allows you to avoid price fluctuations and receive the full principal and interest payments as expected. Credit risk. Credit risk arises when a bond issuer is unable or delaying in repaying principal or interest on time. The risk is higher for issuers with lower credit ratings as their financial stability is less certain. While low-rated issuers may offer higher yields to attract investors, these returns come with a greater risk of default. Therefore, investors should be carefully assess their risk appetite before pursuing higher yields, as chasing returns without understanding the underlying risk can lead to significant losses. Changing in the rating of the company can add risk of increasing the spreads, which in effect can lead to capital loss in holdings. Liquidity. Ability to sell bonds in secondary market to encash holdings is another evolving risk in a bond investment. Bond investors are largely buy and hold, and only a small portion is traded in the market. As I've told, only 3.8% of the bond outstanding is traded. So with the increase in online bond platforms like the fixed income, which help facilitate the liquidity or liquidity for bonds, we can expect an improvement in liquidity. SEBI has also introduced certain measures to help mitigate the liquidity risk, such as delivery versus payment settlement, trade reporting, EBP platform, and RFQ platform. RBI enabled partial credit enhancement, mandated large borrowers to raise a portion of funds via markets, and relaxed norms for finance foreign participation. Challenges in the bond market, which we discussed in the last slide also, it's a liquidity concern. But with the rise of these platforms, you can expect a better liquidity. Minimum ticket size, SEBI and RBI has also helped the market in this manner. They have reduced the minimum ticket size so that more and more retail investors can participate. Understanding of the credit profile. Now, this is for investors. This is very important. Do not chase yields. Invest only after understanding the credit profile of the issue, because the higher yield carries the underlying risk along with it. And there are many other factors which affect corporate bond liquidity, which will help you in while considering your bond investment. Credit rating. Bonds rated AAA to BBB are investment grade and offers higher liquidity. AAA and AA rated bonds have superior liquidity, while speculative bonds have reduced liquidity. As you know, 85% of the issues are of investment grade, and this concern will remain, and lower rated issues struggle to get the investor at competitive rates. Again, issue size. Large bond issues are more liquid because for the liquidity you need the issue size, because they are widely held and frequently traded on exchanges. Smaller issues often privately placed and have lower secondary market equity. Though number of issues increased, investors should look for a high issue size for liquidity purpose. Short-term yields also mirror liquidity conditions. Maturity profile. Short-term bonds provide good liquidity due to lower credit risk and quick exit options. Attracting retail investors, long-term bonds are less liquid, attracting institutional buyers who hold until maturity. Listed status. Listed status also means that your bond are traded on the exchange. SEBI has mandated listing for all publicly issued bonds on NSE and BSE. Listed bonds have greater visibility and easier to liquidate compared to unlisted bonds. Market infrastructure. The Indian bond market is undergoing reforms with electronic platforms, and there are many other measures And also continuous efforts are expected to further ease corporate bond market liquidity. Now, the most important part is the taxation of corporate bonds. Government has also taken initiative to promote greater transparency by initiating different taxation for listed and unlisted bonds. Well, the coupon is taxable at slab rate for both listed and unlisted bonds. Question comes if you want to sell before maturity. Capital gain or losses on selling of unlisted bonds will be taxed at a slab rate, irrespective of holding period, subject to a maximum tax rate of 39%, including surcharge. And the capital gain or loss on selling listed bonds before 1 year will be classified as short-term capital gain and is charged and will be taxed at slab rate, irrespective of holding period, subject to a maximum tax rate of 39%, including surcharge. While the listed bonds one wants to hold for more than 1 year, gains or losses will be qualified as LTCG and is taxed at 12.5%, subject to maximum of 14.95%, including surcharge. So the tax structure has also promoted the trading of liquidity in listed debentures with the tax advantage. The same applies to zero coupon bonds. Before 1 year, it is slab rate, and after 1 year, it is qualified for LTCG and it's taxed at maximum 14.95%, including surcharge. Well, there are also tax-free bonds where the surcharge will not be taxed and they are issued by the specified PFI and PSUs as and when mandated by the government. There are also municipal bonds, and now the more and more issues are coming to help investor interest. Thank you. Happy to take questions.
Thank you so much, Ms. Mansi Kariya, for sharing your valuable insights with us today. Your perspectives on debt market and fixed income space have given us a lot to think about and learn from, and we are ready to accept any questions now. But please make sure that you keep it brief because ma'am is busy, so we can only take a few questions. So please feel free to ask your questions. Okay. Ma'am, if you could, would you be able to tell them what are secured and senior secured bonds? Ma'am, you're on mute. I'm so sorry, you're on mute.
Bonds have a waterfall structure. There are senior secured, which will get the first preference when the company is liquidated in the event of bankruptcy. Then you have secured bonds, then you have unsecured bonds, then you have subordinated bonds. So the senior secured bonds will get the preference over secured bonds, and with the corresponding, they will be traded at the lower yields than secured bonds.
Thank you very much, ma'am. We also have one more question. It's what is the best time to invest in corporate bonds?
Firstly, invest in a best quality corporate bonds. And regarding the best time, what I can tell is when you find the spreads attractive when to take the credit risk. If you won't be buying the corporate bonds less than the government yields. At the time of 2021, the bonds are trading, NBFC bonds are trading at a 5 bps spread than state development loans. So they are not attractive at that time. But if you are getting some considerable spreads over your SDLs, then it is the best time to lock in yields.
Thank you, ma'am. We'll only take a few more questions. Where one person is asking, where do you see the biggest opportunities and risks in India's bond market over the next few years?
Yeah, there are opportunities with the increased regulatory oversight by the SEBI and the RBI. There are opportunities in all the spectrum, but be wary of the credit quality of the issuer and the spreads where you are investing. The risk is most important is the credit risk. Our protection of principal is important. So you can take the advice of a platform or someone in specific expert before investing in lower rated bonds, because there are some ones which might give you 11-12% yield, but it comes with a high risk with the, and the liquidity. Choose only liquid. Choose if you want to sell the bond before maturity, choose the liquid bonds which are regularly traded in the market. Or else, if you want to hold the bond till maturity, the smaller issues is also fine.
That was a great answer. Thank you, ma'am. I have a lot of, I'm getting a lot of questions. I can only take a few more. This one is really good. In today's scenario, how should investors think about debt allocation in their portfolios compared to equity and other asset classes? This, I feel, is very interesting.
There are many aspects. It depends on where you are at your career cycle. What are your goals? You will not take the equity allocation if your goal is of 1 year far away. Equity may give you positive return, but it may go gross negative. So it depends on your allocation, how you want to diversify your portfolio. But my advice is to always have some diversification with the fixed income, which will help you during equity market downturn, and will protect your portfolio and make it less volatile. Depends if the retiree should have more fixed income allocation, and if the person is at the 30s or have a goal far away, they can have more equity allocation than fixed income. But some portion of fixed income is very important to diversify your portfolio. That's what I believe.
Understood. That's really great. A few more. Many retail investors think debt funds are risk-free. What's the biggest myth you'd like to clear about debt investing?
Regarding the debt mutual funds, always look for the portfolios where your fund has invested. They disclose fact sheet every month. You just look after that where they are investing, then what are the issues. You are indirectly investing in corporate bonds via debt mutual funds. So just be comfortable about the credit profile where you are invested. The highest Y2M may give you higher returns, but carry the risk associated with it. You can see disclosure month on month, and accordingly you can decide about which mutual fund.
Yeah, absolutely. Just a few more. I'm really sorry if I'm going to miss someone's, but during the current regime of rates heading south, we have seen some situations wherein the bond yields are forming up. What would be the various reasons for such contradictions? This is Srikant Viswa Mulla.
Including the last 1 month, you can see the government securities yield has also firmed up 30 basis points, and the corresponding state development loans are also firmed up. The corporate bonds, as you can see, track the GSEC bond curve. So it is natural that corporate bonds curve has yield should move up. It will track the government bond market and also the supply. The last month supply was not there, so that they are bit stable as compared to government securities market.
And last question, I'm really sorry if I'm going to miss someone's, but can you please advise on investment in state government guaranteed bonds versus corporate bonds from security of return of principal and interest?
It depends on which state you are investing, about the credit quality of the state. You should take the advice of the expert before investing in any of corporate bonds or state government bonds, to analyze and independently the bond structure. And you should also read the information memorandum before investing in any bonds.
Exactly, yeah. Well, thank you so much. I'm really sorry if I missed someone's questions, but thank you very much, ma'am. On behalf of the entire team and our audience, we truly appreciate the time and expertise you've shared. We look forward to more such engaging sessions in the future. And thank you once again to the lovely audience for joining us. Thanks a lot. And thanks to the Tipsons group for carrying it out with us.
Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risks including delay and or default in payment. Read all the offer-related documents carefully.